The perceived gap between the Federal Reserve and markets, are we closing that gap with the market coming up to the Fed, or do you see the Fed coming down to the market sometime soon?
So we are closing that gap, but I would say I don't really view the gap as that wide, right? So Waller was maybe pushing back on the timing, but I think what he was mainly pushing back on is this idea of very aggressive cuts. So if you remember on the way up, we were hiking 75 basis points a clip. I think what he was trying to push back on is on the way down, this is going to be much more gradual and methodical. Don't expect us to be cutting as fast as we were hiking because we're not in an emergency environment. We're in an environment where the labor market is still healthy, inflation is coming down. That justifies cuts. Pretty much everyone on the FOMC, if you look back at the dot plot, only two showed the Fed funds rate unchanged by the end of the year. So everyone's in consensus there. It's really about the speed. So I actually don't see a huge gap between the market and what the Fed ultimately wants to do.
So 6 rate cuts this year you think is plausible with the rhetoric that we've heard from the Fed?
It is still plausible. I mean, there's only a certain number of meetings in the year. So as you push back on March, that is one less meeting that can be achieved. But I look at the path of the Fed funds rate not just over the calendar year of 2024, because I think we get a little obsessed with these calendar years. And I look at where is the Fed funds rate troughing at. It's troughing at 3.3%. That's the bottom in which the market is pricing the Fed funds rate to get to. That's a reasonable easing cycle. It's not an overly aggressive easing cycle. It's an easing cycle I think is still consistent with soft landing pricing.
What I'm struggling with is there is an inconsistency with this idea of rate cuts, aggressive or not, gradual, sure, but rate cuts that deep with an economy that's moving as robustly as we keep hearing. Is that dissonant for you, or does that make sense?
So I think that the economy does need to moderate for the Fed to continue to have confidence that inflation is going to be sustainably at 2%. So, this isn't supposed to be a situation where inflation touches down to 2% and takes back off. This needs to be an extended stay at 2%. And the way that they get confidence in that is if the labor market cools enough. But I do think under the surface, the labor market is cooling. So, for instance, if you take a look at private payrolls and you strip out government hiring, which tends to accelerate in the late cycle, which is something we've seen time and time again, and you take out education and healthcare, we're actually grinding down to nearly zero on private payrolls growth when you exclude those categories. So I think things are softening, but we do need to be cognizant of that. The fact that the Fed is considering rate cuts does introduce a new tail risk that we weren't thinking about in 2023, which is the reacceleration risk, and we are cognizant of that.